and welcome to the Option Pit webinar of, this is our kind of weekly webinar idea on, some long or short idea, simple buying of options. My name is Mark Sebastian. I'm the founder of Option Pit. This is for educational purposes only and should not be considered any type of investment advice. Consult your legal advisor, your financial advisors if you're looking for legal help. Options are not suitable; they can be advanced. So just be aware. So we've been doing this now for a couple weeks with some success, nothing great. CSX was my first trade. I did a little better than break even. My second trade is Facebook, which was pretty nice yesterday. It got up to about $1.60, and I actually thought about closing my long calls that I own, which I bought for $1.25. So right now I'm basically break even on my my Facebook calls. And then the other trade that I did was in JP Morgan, which is still, those also got up nicely over the week, and I just have not closed them. I'm long. I was pointing out, I believe, these calls, they're still exactly the same price as what I put in for them. So they're up nicely yesterday, about $20. So I'm happy to keep sitting on those, and I don't mind those two little plays. So now I've got two little long call plays on. What's the issue with having two of the kind of the same directional play, even if they're not definitely related? And the answer is, well, you could get stuck with some market correlation risk. So that's why I was looking for stuff with sinking implied vols and a sinking stock. And my first look was Chipotle, which looks really gross and is an ugly looking play. And then the other one that I looked at as a more simple play is Buffalo Wild Wings. Now take a look at this. The stock vol, the implied vol, is as low as it's ever been, basically. All right, if I kind of expand adjust the price chart, I'll just go to 3 months. You can see ugliness, got a little bit of a kind of a dead cat bounce. Now looks like it's setting up for some ugliness, and volatility is falling, which means people are dumping the stock instead of hedging with puts. That is always a bad sign for a stock. Looking across the vols, you can see they're going to list July next week, but I don't mind going into June quite honestly on this one. I think it's an inexpensive play, and with the way this thing is moving, I think I can go somewhat far out of the money. Pay like $1.70. I'm gonna try $1.70. Oh wow, they sold to me for $1.70. So I might have been able to get $1.65, but so that was the trade I just did. I bought a June 150 put. I'm just a little one lot. I'm going to follow along with what it does. My target, I'm not looking for a home run here, but I'd like to get $2.50 out of it, a little 50% return hopefully. And I'm expecting this one to soften. If you got questions about what I'm doing or how I do this stuff, shoot me an email, mark@optionpit.com. You can call me 888-TRADE01. I am doing a free webinar. All right. A free webinar next Wednesday, the 20th. All right. If you go to optionpit.com, all right, you can find all the different stuff that we're doing under events. But this one is pretty simple. It's optionpit.com/creating income. optionpit.com/creating income. You can go register for my free webinar on the 20th. Okay, folks, I hope everybody has a great afternoon, and I'll talk to you soon.